The world of investing is one filled with unpredictability and risk, but with the right mindset and approach, it can also be a world of immense opportunity. One of the biggest hurdles investors face, particularly during times of inflation, is the fear of losing value and watching their hard-earned wealth erode. But inflation, while an undeniable force, doesn't have to be the enemy of wealth. It can be a test of your strategy, your patience, and most importantly, your ability to think long term. In times like these, the value of your money seems to shrink by the day. When prices go up, purchasing power goes down. It's as if you're stuck in a hamster wheel, constantly running but getting nowhere. But let me tell you, this is the exact moment when the most intelligent investors shine. It's easy to get swept up in the panic, the uncertainty, and the frenzy of the market. It's easy to look at the news, watch stock prices tumble, and assume that things are out of control. But remember this, the market has been through tough times before, and it will be again. This wealth is not built in times of calm and peace. It's built in times of chaos. Now, how do we manage this? How do we invest during high inflation, when every instinct tells us to protect what we have, to keep it safe, to hold on to cash and avoid risk? The answer, as counterintuitive as it may seem, is to embrace risk, but embrace it wisely. High inflation presents unique opportunities, but only for those who are willing to navigate the storm with the right tools and strategies. It's not about avoiding risk altogether. It's about taking calculated risks. And that, my friends, is where true wealth is made. We must first start by recognizing that as inflation is a force. It's like the wind. You can't stop it from blowing, but you can adjust your sails to make sure it propels you forward instead of blowing you off course. So, what are these sails that we need to adjust? How do we move in a world where money loses its value more quickly than we'd like? The first step always is to stay calm. Fear is a killer in investing. It clouds your judgment, and it makes you chase fleeting opportunities. Patience is one of the rarest virtues in investing, but it is also one of the most valuable. Investors who focus on long-term goals and resist the temptation to act out of fear can weather inflation better than those who jump from one investment to the next based on the latest trend. During inflationary periods, investing in tangible assets is one of the best strategies to protect your wealth. Let's talk about real estate for a moment. Historically, real estate has been one of the best ways to hedge against inflation. Why? Because real estate is a finite resource. There's only so much land available, and as inflation pushes prices higher, the value of real estate typically follows suit. Now, I know some of you may be thinking, but real estate isn't always accessible, and it's a large capital commitment. And you're right, it does require a certain amount of upfront capital, but real estate isn't the only asset class that performs well during inflationary periods. Another asset that serves as a great hedge against inflation is gold. While some may dismiss gold as a relic, it remains a safe haven during times of uncertainty. Gold has been valued for thousands of years, and when inflation rises, it often performs better than paper currency or stocks. But remember, just because gold has a good track record doesn't mean you should invest in it blindly. Like all investments, it's important to weigh the risks and rewards. Now let's take a closer look at the stock market. I know many of you are probably thinking, but how can stocks be a safe bet when inflation is so high? It's a valid question, but the key here is choosing the right stocks. Investing in companies that can pass on their increased costs to consumers is one way to protect your portfolio. Companies in the consumer goods sector, for example, can often raise prices without losing customers, maintaining profitability during inflationary periods. Stocks in industries like healthcare, utilities, and consumer staples are often more resilient during tough times. But you don't have to simply rely on traditional assets like real estate, gold, or stocks to weather inflation. Bonds can also serve as a strategic tool to maintain purchasing power, as inflation-protected securities such as our Treasury inflation-protected securities are designed to protect your money from inflation's erosive effects. They adjust their principal value with inflation, providing you with a guaranteed return that keeps pace with rising prices. However, let's not get too comfortable with this idea of being shielded from inflation. We must also acknowledge the risks associated with it. Inflation doesn't just affect the cost of goods and services. it affects the cost of borrowing. As inflation rises, so do interest rates. This increases the cost of taking out loans, which can dampen consumer spending and investment. If you have debt, inflation can work against you if you're not careful. With all of this in mind, it's important to stay balanced and diversify your investments. Don't put all your eggs in one basket. That's the number one rule in investing, and it's never more critical than during inflationary times. A diversified portfolio that includes a mix of stocks, bonds, real estate, precious metals, and inflation-protected securities gives you the best chance to protect your wealth and grow it steadily over time. Now, let's pause for a moment and think about the bigger picture. What are you really investing for? Are you investing just to survive, or are you investing to thrive? During times of high inflation, it's easy to focus solely on the short term, on protecting what you have. But remember, as true wealth building comes from long-term thinking. Patience is not just about holding on to your investments. It's about being able to look beyond the current challenges and see the opportunities that await. Inflation may be painful today, but it's the smart, long-term investors who are able to make the right decisions now, who will see their wealth grow tomorrow. Let's continue by examining the mindset of an investor who seeks not just to survive during inflationary times, but to thrive. Wealth is not created in moments of comfort. It is forged in the fire of adversity. During times of economic uncertainty, it's easy to become discouraged, to feel as if the world is working against you. But adversity creates opportunity if you have the right mindset. So, how do we approach investing during inflation with the right mindset? The first thing to understand is that as inflation is not a temporary problem. Sure, it might feel temporary at times, but inflation can last for years. It's a persistent force that erodes the purchasing power of your money. And as we discussed in the first part, there's no way around it. You can't wish it away. But you, can, make sure your money works harder for you by investing in assets that not only preserve but also grow your wealth. Think about it like this. When inflation is at its peak, everything seems to cost more. Gas prices go up, groceries go up, housing costs go up. But what happens when you own real estate during inflationary times? The value of your property increases. Your rental income increases. And if you own businesses or stocks in companies that can pass on those higher costs to consumers, your profits go up too. So, instead of sitting on the sidelines, scared of inflation, take a step back and think, how can I position myself to thrive in this environment? This isn't a time to panic. Yes, this is the time to double down on your strategy, to stick to the plan that works in the long run. Wealth building is not about short-term gains, it's about consistent growth over time. Patience and persistence win in the long run. Let me tell you a story, something that comes to mind when I think of the kind of mindset needed to succeed in high inflation times. There's a story about one of the most successful investors in history who, during a major economic downturn, took a step back when others were running for cover. While others were selling out of fear, he was buying because he understood that these market conditions, while uncomfortable in the short term, would eventually lead to an incredible opportunity. That investor made his money not by running away from risk, but by embracing calculated risk, by putting his money in areas that would withstand the storm and ultimately come out ahead. That's the kind of mindset you need. So, what are the key lessons we can learn here? One's resilience is key. Stay focused on your long-term goals even when the economy is challenging. Resilience will carry you through tough times. 2. I learned to embrace risky. Inflation increases risk, but the right investments can mitigate that risk. Stocks, real estate, bonds, and commodities are all ways you can use risk to your advantage. 3. As we mentioned earlier, diversification is crucial. Don't just invest in one asset class. Spread your investments across a variety of assets to protect yourself from unexpected shifts in the market. And remember, diversification doesn't just mean buying different stocks or bonds. It means investing in different sectors, different geographies, and different types of assets. As we move forward in this conversation, let's get more granular with our discussion on how to allocate your investments during inflation. Which assets should you consider? What strategies should you adopt? First and foremost, precious metals like gold and silver should be part of your strategy. as gold has been a traditional hedge against inflation for centuries. When paper currency loses value, gold holds its ground. During the Great Depression and the 1970s inflationary period, gold prices surged. So when inflation is running high, as gold can provide stability and growth. But gold isn't the only precious metal you can look to. Silver also has historically performed well during times of high inflation, though it is more volatile than gold, as its value often increases during periods of inflation as it is used in industrial applications and as a store of value. Next, consider as real estate. Real estate investments are an excellent hedge against inflation. When inflation rises, so do the costs associated with building new homes and commercial properties. Whereas real estate values generally appreciate over time, and property owners can increase rents in response to rising costs. But real estate is not just about buying physical property. Consider investing in real estate investment trusts (REITs). These allow you to invest in real estate without the burden of owning property outright. REITs typically offer strong returns during inflationary periods and can diversify your portfolio. Moving on, let's discuss the stocks, particularly those in sectors that tend to thrive during inflation. As consumer staples like food, beverage, and household goods companies often do well because they can pass along higher costs to consumers without losing demand. Healthcare stocks are another good bet, as medical care is an ongoing necessity for people no matter how high inflation goes. Additionally, as energy stocks in the oil and gas sector can thrive during inflation since the demand for energy tends to remain constant, and companies can pass along the higher costs. Now, let's not forget the importance of bonds, especially inflation-protected securities like T-Piece. These bonds are designed to protect investors from inflation by adjusting the principal value with the consumer price index. So as inflation rises, so does the value of these bonds. The only downside to T-Piece is that they may offer lower yields than traditional bonds, but their protection against inflation makes them valuable. The final part of our strategy is emphasizing businesses that can adapt to rising inflation. Companies with a strong brand loyalty, pricing power, and there's the ability to innovate are the ones that will weather the storm. Take a moment and think about some of the best companies in history. Many of them didn't succeed because they had the best product or service. They succeeded because they could adapt to changing conditions, including inflation. As we continue our exploration of how to successfully invest during high inflation, let's now turn our focus to the psychological aspects of investing during challenging economic times. It's easy to get caught up in the chaos, to let fear or uncertainty dictate your actions. But the true investor, one who has a clear, long-term vision, will remain steady even when the storm clouds are gathering overhead. The power of emotional discipline is often overlooked in the investment world. When inflation rises, emotions like fear and greed can take hold of us. We see prices going up, and we panic, believing we must act quickly. On the other hand, some people might get too greedy, thinking that any price increase is an opportunity to jump into a risky asset without fully understanding the risk. But the key is emotional control, the ability to remain calm and make decisions based on rational thought, rather than emotional reactions. Take, for example, the concept of bars, buying low and selling high. This is an adage that many investors have heard 1,000 times. But it's more than just a catchy phrase. It's the bedrock of successful investing. Yet, during periods of inflation, we often see the opposite happen. Investors rush to buy into the latest trendy stocks or commodities because they fear missing out, only to sell when prices begin to dip, only to regret it later. The key here is to understand that markets are cyclical. They go through ups and downs. And if you have the right perspective, you'll see inflation as an opportunity to acquire valuable assets at a price that will be worth more in the long term. This is where patience becomes critical. It's easy to get caught up in the urgency of the moment, but investing is a long-term game. During inflation, the biggest winners are not the ones who act hastily, but those who remain calm, who ride out the storm, and who invest in quality assets that are designed to withstand inflation. There's a great deal of wisdom in the idea of focusing on what you know. And in times of inflation, this wisdom is even more crucial. Let me ask you a question, guys. How many times have you heard people make the mistake of chasing the latest hot stock or trend, only to be left holding the bag when the bubble bursts. The same thing happens during periods of high inflation. When people are uncertain, they seek what appears to be a quick fix, a shortcut to wealth. But true investors know that as wealth is built steadily over time with consistent, careful choices. A perfect example of this comes from the tech bubble of the late 90s. People rushed into the stock market, chasing after the next big thing, tech stocks. But many of these companies were built on vapor, without a sound business model, a steady revenue stream, or a clear long-term strategy. When inflation started creeping up, many of those companies couldn't handle the pressure. They collapsed. And the ones who remained, the ones who succeeded, were the ones with solid fundamentals and a business that could adapt to changing economic conditions. The same principle applies today when investing in the face of rising inflation. First, focus on the long term, focus on value, and focus on companies with strong, sustainable business models. If you get caught up in the frenzy, the odds of losing money are high. But if you invest in businesses that are built to thrive even when inflation is running high, you position yourself to come out ahead. This is not about chasing fast profits. This is about savvy investing in wealth that lasts. Now, let's touch on the critical role of cash flow. As inflation may hurt your savings, but companies that can generate consistent and growing cash flow, that's where the true value lies. Think of companies that have as consistent earnings and pricing power. They can pass on the costs of inflation to consumers without losing demand. And for you as an investor, that translates into consistent returns over time. For instance, let's talk about dividend stocks. Many of the best dividend-paying companies have the ability to increase their payouts during inflationary periods. And why is that? Because these companies are able to generate strong profits and then pass those profits along to shareholders. As inflation pushes up prices, those companies adjust accordingly, and their ability to generate cash flow increases, which in turn supports a growing dividend. This is the beauty of owning stocks in companies that can increase their prices. If we break it down, the best assets during inflationary periods are those that can generate predictable income, whether it's through dividends, rents, or interest. And the best way to position yourself in these kinds of assets is through investing in stable, cash flow generating businesses. Now, many people look at the stock market and think, isn't the market just a roller coaster? How can I possibly trust that my money will be safe there during inflation? Yes, the market can be volatile, but if you stay focused on cash flow and long-term growth, you'll begin to see the market for what it truly is, as a tool to build wealth over time, not a gambling arena for short-term speculation. Let's not forget the immense value of investing in bonds, particularly as inflation-protected bonds like TPS, which we discussed earlier. These bonds provide a reliable source of income and act as a hedge against rising prices. During inflationary times, the yield on types rises with inflation, so it can be a great way to preserve and grow your purchasing power. As we dive deeper into how to successfully invest during high inflation, it's important to take a step back and consider the broader perspective of how inflation impacts different types of assets. While it's easy to feel overwhelmed by the rising prices of everyday goods, we must remember that inflation is not a monolith. It doesn't affect all assets equally. By understanding the nuances of how different investments react to inflation, you can better position yourself to ride the wave rather than be crushed by it. Let's begin with real estate, which is often considered a safe haven during periods of inflation. Real estate can act as an effective hedge against inflation, as property values and rents tend to rise when inflation increases. Think about it: as the cost of materials, labor, and interest rates rise, home prices generally follow suit. This dynamic gives real estate investors an opportunity to benefit from inflationary pressures. But it's not just about buying property and waiting for it to appreciate. The real advantage of real estate comes from rental income. During inflationary periods, as costs rise, so do rents. If you own rental properties, you have the ability to pass on those higher costs to your tenants. And in turn, you keep generating a reliable income stream. If done strategically, real estate can protect you from inflation while simultaneously providing you with the opportunity to build wealth over time. However, The key to real estate investing is not just buying any property, but focusing on S properties with strong cash flow potential. S location is paramount. You want to look for properties in S areas with strong demand, places where people want to live and businesses want to operate. This could be in urban centers or emerging neighborhoods where the demand for housing is rising. When inflation hits, these properties will be able to weather the storm far better than properties in less desirable locations. But remember, real estate isn't always as easy as it seems. It requires capital, time, and effort. But if you can navigate the complexities, it offers a fantastic way to preserve wealth and build long-term financial security. But as I always say, don't rush in, take your time. Real estate investing isn't a get-rich-quick endeavor. It requires patience, diligence, and research. Moving on, let's discuss the precious metals, particularly as gold. Many investors turn to gold during inflation because it has a long history of maintaining value during times of economic uncertainty. When inflation erodes the value of paper money, gold tends to always hold its purchasing power. And for that reason, many savvy investors view gold as a store of value. However, I want to caution you about relying too heavily on gold or other precious metals. While they are indeed a safe haven, during inflationary periods, they don't produce cash flow or dividends. Gold does not pay you to own it. So, while it's a great tool to protect your wealth from inflation, it shouldn't make up the bulk of your portfolio. A balance is key. Gold should serve as a piece of the puzzle, not the entire solution. If you're going to invest in precious metals, you need to have a diversified portfolio that includes 6 stocks as far as bonds, and perhaps as real estate in addition to gold. Gold has its place, but it's not the only solution to inflation. You need to diversify, especially in volatile periods. The best investors know that the diversification isn't just about owning a variety of assets. It's about owning the right combination that can weather different economic climates. Now let's turn our attention to commodities, another area where many investors seek refuge during inflationary periods. Commodities like oil, natural gas, and agriculture tend to rise when inflation picks up as the cost of producing these goods increases. However, commodities come with their own set of challenges. They can be highly volatile and impacted by geopolitical events, weather patterns, and other external factors that make predicting their price movements difficult. For example, the price of oil can be influenced by OPEC's decisions, or even IRA's technological breakthroughs in energy production. Agriculture prices can swing due to crop failures, global demand changes, or even trade policies. So while commodities can be an excellent way to hedge against inflation, they also require a certain level of expertise and attention. Risk management is crucial. Some investors opt to invest in commodity ETFs, which allow them to gain exposure to a basket of commodities without directly buying the physical goods. While these ETFs can provide diversification, they also carry their own risks. It's important to understand that commodity investments should be part of a broader strategy rather than the core of your portfolio. The question then becomes how do we manage the risks of inflation while maximizing returns? The answer lies in diversification, patience, and a long-term vision. Inflation can be unsettling, but it's also an opportunity. It's an opportunity to position your portfolio in ways that protect your wealth while also positioning yourself for future growth. So when it comes to high inflation, don't panic. Instead, focus on what you can control your investment strategy. Ensure that your portfolio has exposure to assets that outperform during inflationary periods, while at the same time maintaining a long-term mindset. Avoid the temptation to chase quick profits or overreact to market noise. A true wealth is built slowly, with intention, purpose, and a disciplined approach. One other critical element in protecting your investments during inflation is interest rates. Inflation and interest rates are deeply connected. As inflation rises, the central bank usually raises interest rates in an effort to cool down the economy. This impacts everything from bonds to mortgages and consumer spending. So, it's important to stay informed about the direction of interest rates, as they can have a significant impact on your investments. Interest rates often dictate the flow of capital. When rates rise, certain sectors of the economy, such as real estate and consumer stocks, might feel the squeeze. while others, such as financials, could benefit. The key here is to stay flexible. The economic environment is constantly changing, and inflation is just one factor in the larger economic landscape. Our adaptability will allow you to capitalize on new opportunities and minimize risk as inflationary pressures ebb and flow. Now that we've explored the various asset classes you can leverage during high inflation, it's time to talk about how to stay emotionally balanced during times of market uncertainty. The one thing I've seen time and time again, especially during periods of high inflation, is how people tend to let their emotions drive their financial decisions. Whether it's fear, greed, or sheer panic, emotions can cloud your judgment and lead to poor investment choices. But remember, as success in investing is built on a solid foundation of patience, discipline, and above all, rational decision-making. In times of inflation, emotional resilience is more important than ever. The key to investing successfully during turbulent times is to stay as calm and methodical. For instance, during periods of high inflation, the stock market often experiences significant volatility. In the face of rising prices and increasing interest rates, investors may become overly reactive, trying to time the market or make dramatic shifts in their portfolio. However, market timing is a fool's game. It's incredibly difficult, if not impossible, to predict short-term market movements. The best investors are those who understand that it's the long-term trajectory that matters most. Let's take a step back and think about one of the best lessons I've learned is don't panic. It's easy to let your emotions dictate your actions, but successful investors have learned the power of restraint. During inflation, it's natural to feel concerned. Prices rise, purchasing power erodes, and the future feels uncertain. But here's the truth: uncertainty is a constant. It's always there, lurking just below the surface, and yet successful investors have learned how to thrive in the face of it. They don't let the fear of inflation or short-term market volatility push them into rash decisions. Consider the story of Warren Buffett. He has been investing for decades through every type of economic climate imaginable, including the 1970s, which saw significant inflation. But despite the challenges, Buffett continued to make long-term investments based on solid business fundamentals, not short-term fluctuations. He understood that price fluctuations were part of the journey, and he maintained his focus on the intrinsic value of companies rather than their market price. This is the mindset that we need to adopt in times of high inflation. Sure, inflation can drive up the cost of living, it can push asset prices higher, and it can rattle investors' confidence. But if you allow yourself to be swept away by fear, then you might miss out on opportunities that come with volatility. Because even in the face of inflation, there are always investments, whether in stocks, real estate, or commodities, that can provide you with this opportunity to grow your wealth. So what can you do to stay emotionally grounded during inflationary times? First, focus on your long-term goals. High inflation is a temporary condition in the broader scope of history. The markets are cyclical, and inflation will subside at some point. Staying focused on your investment horizon, whether it's 5, 10, or 20 years, will help you avoid the temptation to make drastic, emotionally driven decisions. Second, keep your investment philosophy simple and clear. When you have a well-defined investment strategy based on solid principles, it becomes easier to resist the emotional urge to chase the latest hot tip or sell everything in a panic. If you've done your homework, have a diversified portfolio, and invest with conviction, you'll be better able to ride out the ups and downs of the market. Third, stay disciplined. In times of high inflation, it's easy to be lured by the latest trends or to believe the hype surrounding certain sectors or stocks. But the most successful investors resist the temptation to follow the crowd. They stick to their value-driven approach, investing in businesses with strong fundamentals and sustainable competitive advantages. Stick to what you know and what works. This is the ultimate key to making wise decisions, especially when inflation is high. Now, let's talk about something I've seen countless times during my career in investing. The mistake of overreacting to inflation. It's important to understand that inflation isn't the enemy. It's a natural economic phenomenon. What matters is how you react to it. If you fall into the trap of thinking that every inflationary spike signals doom and gloom for your investments, you're setting yourself up for failure. For us, the real danger lies in reacting out of fear and abandoning your long-term strategy. The reality is that inflation can create opportunities just as much as it can present challenges. During high inflation, certain sectors, like as energy or as precious metals, can actually benefit. Understanding these dynamics gives you a competitive edge because it means you can take advantage of opportunities that others might overlook in their rush to sell off assets. This is the power of us understanding the economic environment. It's about making sense of the shifting landscape and positioning yourself accordingly. And while inflation can cause short-term discomfort, it's also a great teacher. High inflation teaches you the zera's importance of financial discipline and the necessity of building as long-term wealth. It forces you to think critically about how money works and how to build resilience in your financial strategies. I've always said that wealth isn't built overnight. It's a long, patient journey, one that requires consistent effort, smart decisions, and above all, the courage to stay the course. This is just as true during periods of high inflation as it is during calm periods. If you're able to weather the storm, avoid emotional decisions, and keep your eyes on the long-term prize, you'll come out stronger on the other side. If you look back at past periods of high inflation, the investors who survived and thrived were the ones who focused on what they could control. They didn't waste time worrying about things they couldn't change. Instead, they made deliberate choices about their investments, stayed calm in the face of uncertainty, and made sure to diversify their portfolios to mitigate risks. In times like these, the key to success is taking calculated risks, diversifying wisely, and staying true to your investment philosophy. And so I leave you with this: see inflation as a fact of life, but it doesn't have to be a barrier to wealth. In fact, it can be an opportunity to take control of your financial future. Sharpen your investment skills, and grow your wealth even in tough times. It requires patience, a clear mind, and the courage to stick with your principles. Don't let fear or panic drive your decisions. Instead, focus on the long term, remain disciplined, and use this time to refine your strategy. Now, as we near the end of this journey through high inflation, I want to leave you with a few final thoughts that I hope will resonate deeply with you as you navigate these turbulent waters. Inflation is, without a doubt, a disruptive force. It changes the landscape, alters how we view money, and pushes us to rethink how we manage our investments. But I'll tell you something, there's no need to fear it. What you need to fear is a reactionary decision-making, chasing after trends, or abandoning your principles simply because the winds of inflation seem like they're blowing too hard. Remember, wealth is not about short-term gains. It's about making smart, thoughtful decisions, understanding the long-term game, and staying consistent. Wealth doesn't grow overnight, and high inflation isn't a monster lurking in the shadows, waiting to devour your portfolio. It's a challenge, yes, but it's a challenge that's intelligent, disciplined, and rational investors know how to navigate. Let me share one final analogy with you. Think of inflation as a storm. It can cause chaos in the short term, create uncomfortable waves, and disrupt the seas. But if you're in a well-built boat, equipped with the right sails and the right course, that storm won't destroy you. It might make you rock a little. It might make the waters a little rougher, but it won't sink you. That boat, those principles, and that long-term vision are what will carry you safely to your destination. And remember, in times of uncertainty, it's not about avoiding risks altogether, but about taking the right risks, the ones that align with your long-term financial vision, that suit your risk tolerance, and that come with the right amount of patience and discipline. Stay the course. Invest with a mind focused on long-term goals, not short-term noise. Stay diversified. Understand that inflation might push the markets around, but it also creates opportunities. Just like every challenge in life has its hidden opportunities. Investing is a marathon, not a sprint. Inflation is but one of many hurdles that you will face on this journey, but it is not an insurmountable one. By making thoughtful, informed decisions, you will outlast the storm and come out on the other side stronger, wiser, and wealthier. And finally, let me remind you of the power of consistency. In a world that thrives on instant gratification and immediate results, consistency is the rarest and most valuable virtue you can have as an investor. Keep investing, keep learning, and keep building toward your future. Remember, it's not about timing the market, it's about as time in the markets. The right choices made consistently will pay dividends over time. Stick to your principles, diversify wisely, and hold steady through the storm. The rewards will be waiting for you when the clouds finally part, and you'll be the one standing strong, as having built something that lasts. Your journey toward financial freedom is yours to define. High inflation is just a chapter, not the whole story. And when you look back on your investment journey years from now, you'll realize that it was not the challenges you faced that defined you, but the choices you made in the face of those challenges. I wish you clarity, patience, and a future full of opportunities, no matter what the markets throw at you. Stay grounded, stay focused, and above all, stay true to yourself.